Welcome to Opal STV. I am in Sydney, Australia, together with Stephen Goldman. He is the managing director of Kapstream. How did you become a hedge fund manager?
Well, actually, I've spent my entire career in fixed income portfolio management, going back about 23 years now.
And when did you set up Kapstream? What's the corporate history of Kapstream?
My colleague and our chief investment officer, Kumar, Palghat, founded Kapstream in 2007. I actually didn't join until 2010. We were old friends. We had worked together back starting our careers 23 years ago at the World Bank, and we had kept in touch as he started Kapstream, and it just came that the business had grown over the years, and he needed another person to help him manage the portfolios. The new person hired last year.
Now tell us more about the strategies that you run, and what do you think is special about Kapstream?
I think one of the biggest differences in how we run our money versus most other managers, including hedge fund managers, is we think of ourselves as what we call an absolute return manager. And to us, what that means is different in contrast to a hedge fund. We don't really lever our portfolios. What we try to do is just buy the best bonds that we believe that are available out there today. We don't take, if you give us $100, we will invest $100. We won't invest $150 or $200. We won't consider things like benchmarks. We'll just buy what we think are the best opportunities in fixed income markets available today.
Do you invest globally? What's your investment universe?
Yes, we invest globally. We're really seeking the best opportunities that are available globally.
How does being Australia help you in your investment, and how has your strategy performed, and what type of money do you run right now? What is your asset size?
Today we're running about $3.7 billion in assets. Most of those assets are Australian assets, although we do have some global asset as well. Our benchmark has been roughly 7 to 9% returns. Since inception, we're in that range. But I think one of the other key selling points for our product is in the 45 months that we've been around, we've had positive performance in all of those months with the exception of 3. And our worst down month was minus 0.18% or 18 basis points.
Absolutely impressive. How do you achieve that? What's the role of risk management, or how do you do your risk management?
Well, if you're going to run your portfolios that way, risk management is critical. And the way that we think about the world is we build a portfolio of fixed income instruments that have a yield in today's world of roughly a little over 7% a year. That translates into about 0.6% or 60 basis point a month. And when we add other strategies to our portfolios, and those strategies could include things like duration management, country relative value, playing in credit default swap space, what our goal in adding value through these strategies is to make sure we don't lose that 60 basis points a month in yield through other strategies. One other thing, and the goal of these other strategies that I'm talking about is to add roughly another 2% on to our portfolio returns. So we'd like to get the yield of the portfolio plus another 1 to 2% through other derivative type strategies.
Can you tell us more about the other derivative type strategies that you overlay and how you do it?
Sure. So an example of some of the derivative strategies that we're putting on in the portfolio would be things like, we believe that Australian rates are going to outperform U.S. rates. So we could do this through futures markets or swap markets. We would take a long position in Australian 10-year rates versus a short position in U.S. 10-year rates. Or another trade that we've had on for a while in our portfolios has been a belief that the European banking sector is under more stress than what markets currently anticipate. We like the U.S. banking sector better than the European sector. And so what we've done is we've bought protection through credit default swaps on European banks, and then against that we've sold protection on U.S. banks. And those would be examples of some of the trading that we would put on in the portfolios.
Steve, you're based in Australia. You built your business in Sydney. Being based in Sydney, how much does it help you to run your business? Or are there times where you think, oh, well, maybe we should move all to Hong Kong or to London or to the US?
Well, I think in the long run, it is definitely our plan to eventually move to the US and to Europe. But I think the reality is, we started our business roughly 4 years ago, and Kumar Palghat, our Chief Investment Officer, has been a portfolio manager in Sydney for about 10 years now. So in beginning to build the business, it was natural that the client base was Australian, and that's where we've gotten to today. In the longer run, we think this absolute return concept is applicable around the world. And so we'd like to eventually have a European and a US absolute return product. There's a couple other products that we're working on as well. One of them is an Asian bond fund, where being in Asia, I think, is a natural advantage to run that type of fund, where we'll be buying just Asian bonds solely, the bonds and the currencies. And I think to us, that means that we'll need to expand beyond Australia, because the natural investor base for those type of products is well beyond Australia.
But is the demand for absolute return products in fixed income, is it increasing, or how do you see, or what are the activities on the investor side here?
Well, I think it's definitely increasing. If you look back a couple of years, the absolute return products just didn't exist. I think they've become more attractive more recently, especially for the fixed income world, mainly because people believe that interest rates are going to rise and bonds are going to have negative returns. So they've been prepared to allow managers to take different types of risk. And so for ourselves, we are a believer that eventually bond yields are going to rise. That would mean that most bond benchmarks are going to have low or negative returns. So the concept of absolute return, not worrying about benchmarks, managing your duration not according to a benchmark, but according to your views of where interest rates are going to go, is probably a better way to manage bond portfolios. I think that's been the key selling point for our product, why we've been successful to date. And my guess is going forward, people will be moving more toward absolute return, away from benchmark type portfolios.
You mentioned you are starting out this Asian bond portfolio, and you're obviously based in the Asia Pacific region. What's your view on the increasing significance of Asia within the global economy? And what is it that you think investors should be aware of?
Well, we are believers in the Asian growth story. We're generally believers in the global growth story, led by the U.S. as the U.S. comes out of its slowdown. We think that the money that will be pumped into the U.S. and the world economy will find its way to Asia, which will be more competitive in the manufacturing sector. Will be bringing people out of the farms into the manufacturing sector, and that it'll be a very positive story for Asia in terms of growth. That's the reason that we like Asian bonds, particularly as markets are opening. We're seeing less capital controls, less government restrictions on investments in Asia. We're positive on the currency as well, and we think generally, as we look around the world, that Asia is the most attractive opportunity.